Welcome everybody to this month's webinar. The title today is Acquisition Criteria of Buyers in a Bear Market. Clearly very topical given the performance of the stock markets, the e-commerce sector, and of course our own industry, e-commerce exits. So welcome everybody, look forward to a great session. To start, I just want to give a brief introduction to the Fortia group. For those that don't know us, our exclusive focus is M&A in the e-commerce space. So every day we get up and we think about how we can help e-commerce owners maximize the value of their businesses to a great network of buyers across aggregators, private equity firms, and corporates. For brands, we have 3 solutions. Delighted to say that we have 22 live mandates. We can offer brands an estimate of the value, which is clearly really critical in this current market environment to get a finger on the pulse and a proper realistic valuation. For those firms that are not ready to exit today, we have an exit ready program where we can prepare you for an exit, even if that's in 2023, 2024. And of course, if for brands that are ready to sell now, we have an investment banking type 7-step granular process for clients that want to exit. We have 12 firms in that process at the moment. I want to make it really clear that for the aggregators on the call, we also provide corporate finance services to you. We on the way to prosper, the conference back in March, we coined the phrase MOA, which instead of M&A stands for mergers of aggregators. We've seen some movement in this area. But if there are aggregators on the call that are interested in selling some of their brands or indeed their entire firm, please do reach out. We will apply the same investment banking type process to all our deal flow. In terms of deal flow, our view to try and simplify it is the key to getting the best deal is the 3 Ps. So it's all about having the right people on your side of the negotiation table. It's bizarre in our view that some entrepreneurs try to do exits themselves. Even Fortune 500 companies have advisors. I learned my trade in M&A at Morgan Stanley and Credit Suisse. So we're looking to bring a thoroughbred investment banking type solution to this space. Process, it's important to run a really thorough process. Looking after process and systems will ultimately get you the right result rather than focusing on just the result. And we have a really granular 7-step process we put all our brands through. And ultimately, it's about approaching all of the right purchasers, whether that's aggregators or for the right size brands, private equity, or indeed corporates. It's important to approach all of the relevant buyers to get the best deal. We are, building our social media presence and our touch points. So please do keep in touch with us. We have a monthly newsletter that you can just subscribe to via our website. If you're already on our CRM, you will receive it. Please do follow us on LinkedIn or on Facebook. All of the webinars, including today's webinars, are available on our YouTube page. We've been doing webinars since October last year, so a lot of really good in-depth content available for you there. And if you want to refer brands to us, we're happy to pay for those referrals. Please do reach out to me direct at emmett.kilduff@thefortiagroup.com. Okay, we're delighted to say that we spent over 8 months now building a really high quality monthly webinar series, and we are delighted to welcome Lequeux as the lead sponsor of the series. It's important for us to have like-minded, really thoughtful partners that can help turn what we've already built into the definitive monthly webinar series for the e-commerce space. We have big ambitions to make this even better as we go forward. So thank you, Lequeux, for backing and partnering with us. Lequeux is the first and the leading revenue-based funding company. And it's important to note that they have great solution for brands. A lot of the brands we speak to on a daily basis who are looking for financing as a way to grow, but they also increasingly have solutions for aggregators as well. So please do reach out to us if you would like an introduction to the relevant person at Lequeux to further discussions, again, whether you're a brand or an aggregator. Clearco is the title sponsor of the webinar series, but we are looking for additional sponsors. It could be a 3PL, it could be a service provider, a tool or a solution for the e-commerce space. Please do reach out. We want to, as I mentioned, have the highest quality sponsors and partners of the webinar in order to continue to improve it as we go forward. Okay, so all of our webinar topics are demand-led, i.e. we survey you, the audience, and we frankly just ask you what topics you want us to cover. Today's topic was a hotly requested topic, given we've just entered or are entering a bear market. What does that mean for the acquisition criteria of aggregators or wider buyers, whether it's private equity or corporates? So delighted to make that request a reality today, and we can jump in now into the detail. So in terms of how we structured the rest of the webinar, we have TED type talks by 8 aggregators. For those of you that joined the last session, we had 10 CEOs of aggregators talk about the future of the aggregation space. That's had over 1,000 views on our YouTube channel. Please do take a look if you haven't seen that. And today we're challenging 8 senior folks from aggregators to give TED type talks on the acquisition criteria in a bear market. We'll follow that up with a brief presentation from myself about for the Fortia group's views of how criteria are changing in a bear market based on what we're seeing in the marketplace. And then we'll have lots of time for discussion and audience Q&A. In terms of Q&A, please do submit it via the Q&A button on Zoom. Please do not submit it via the chat, as it's very hard to track the Q&A. Okay. With no further ado, let's jump in. And I'd like to welcome Alexei Pevoski from Alphagreen to kick us off. Over to you, Alexei.
Awesome. Hi, everybody, and thanks for taking the time and the invite. Awesome. So you will change the slides, right? Or should I?
Correct. Yeah.
Okay, perfect. So let's then, I guess, quick intro. We actually started as a brand in the CBD space, and then we started acquiring brands and also added a growth agency to our business model. So I'm going to present 3 slides today. First one, kind of going from bull to bear market. Second, in terms of value add being even more important today than ever. And then the third, that maybe it's actually time to add your own brands and build out more products than just looking at acquisitions. So maybe, yeah, moving on to the first slide, we can see that the majority of acquisitions have been made around kind of end of 2020 and kind of beginning of 2021. And the majority of acquisitions have been actually made at all-time high sales, at all-time high multiples, with all-time high margins. And what it means is that there is very, very little room for failure, which means that if you do actually have a decreasing margin due to, let's say, inflation or supply issues or something else, you might end up kind of suffering because of the debt, for example, used to finance the deal. And so we saw that while in 2021, it was all about, okay, more revenue is better. Yes, margins were important, but it was really about the speed of acquiring as many brands as possible. We now know that with sales normalizing after COVID, margins normalizing with all these issues out there, including geopolitical tensions, we now know that paying a multiple on a very clean EBITDA is more important than ever. And so we see that this is also really important in the future. We see that when looking at businesses now, there will be kind of like a big discount already made for kind of any future risks there will be, because we've probably not seen all the risks already in the market. So we expect it to get worse before it gets better. Obviously, we are very bullish on Q4 because it's seasonality related, but then we actually expecting another kind of drop, and 2023 being kind of flat as well. And so we're looking at multiples being low in the future as well. Now, moving on to the next slide, how do you improve your margins, for example, and where do you see the potential? That's a really important question now. And so looking at the various growth levers, we kind of split it into, you know, anything around revenue drivers, cost drivers, and scale drivers. So revenue drivers being, okay, can we increase the PPC? Is it not as high? Can we extend into international channels? And then obviously scale drivers, anything around new product development. Is that brand we are looking to acquire? Is it kind of like broad enough to really go into, let's say, for example, we acquired a scented candles brand. And so there are quite a few areas we can expand into, be it reed diffusers, other gift sets, aromatherapy, oils, et cetera, et cetera, et cetera. And so that's really becoming very important as well. And then finally, of course, are there any levers around the cost side which we can decrease, be it switching the supplier or changing to a kind of a different material, et cetera, et cetera. And then finally, the third slide. In terms of acquisition criteria in general, so while we are extremely bullish still in terms of there are so many amazing brands out there, and with multiples going down, it is actually a very attractive environment again to acquire companies, especially given we know what the normalized margin looks like, and given, you know, the sales are kind of normalized rather than an all-time high. We also see a really big opportunity to develop our own products and our own brands. Again, we also built in the past a sleep brand called Yawns. So we are actually looking to continue to innovate and to actually launch brands, because in a recession, the customer cost of acquisition does actually go down. And so launching brands in a recession is actually a really, really good thing. And basically that slide is kind of like outlining our process, how to get a rapid product market prototyping done, rather than that standard brand creation with a bunch of different intermediaries in the middle. And obviously we use our new Optima agency for that, our own platform, and we can of course also help other people doing so. But yeah, that's how we're looking at the beer market. So it's not only gloom, there is actually also a lot of opportunity, and kind of great future in the long term.
Great. Thank you, Alexei. There's a question in the Q&A box. If when you get a moment, please take a look at that and type an answer separately.
Yeah.
Thank you for kicking us off. So let's go over the pond to New York, and we invite Alex from Branded. Over to you, Alex.
Great, thanks very much, Emmett. Good afternoon, everyone. I'm Alex Meyerguz, as I mentioned. I lead acquisitions at Branded e-commerce group. So we can dive right in here to kick things off. And I apologize in advance if there's going to be some repetition here. I know I have the fortunate advantage this go around to be kind of earlier on in the presenter set. So if some of this gets covered multiple times, I'll apologize in advance on behalf of some of my other esteemed colleagues on the call. But just to quickly contextualize the bear market, obviously don't need to harp on much of this. We've all read the headlines. The economy, you know, has seen some challenges in 2022. A lot of headwinds, both for companies and consumers alike, with the stock prices being depressed, skyrocketing inflation, the war in Ukraine, and other geopolitical instability, rising rates, and other kind of more macro challenges. You know, clearly that's had an impact on M&A, as many other things. I actually think it's not, you know, it's not all doom and gloom. As Alexei even mentioned, you know, there's still unemployment's at record low levels. And while interest rates are being raised, again, in a historical context, they're still quite low. And so I do think there's silver linings and upside. But needless to say, all of these headwinds have had an impact on M&A. And if we go to the next slide, we can kind of see some of that on a very macro basis, right? This constrained access to capital, this more expensive debt, and this continued sort of elevated risk and perceived uncertainty in the market has led to a slowdown in deal volume. And so, while there's definitely, you can see this decline in the first half of 2022, this is from PwC analysis, it hasn't really been catastrophic, I would say. In fact, I think current deal volumes are in line with some healthy pre-pandemic levels, but volumes and values have declined by 20% compared to the first half of 2021. And we think there's still likely to decrease, potentially even further going forward. And all that said, though, this might present some better opportunities for investors to generate healthy returns, right? In today's environment, as valuations come down, it's implicit that there's more upside. But of course, this is a very, very macro view. And if we double click on the next slide to how it's more relevant to all of our worlds, which is this FBA aggregator space, certainly those M&A headwinds have extended here. At a very high level, the pace of M&A in this roll-up space is largely dependent upon access to capital, right? It's dependent on being able to get, more and more funding, more access to debt and equity. And, in the private company growth company space, there's certainly been a decrease in venture funding into kind of earlier stage private company growth ventures, as much as over 25% quarter over quarter, looking at Q2, which is the largest quarterly drop in a decade. And in the aggregator space specifically, funding is down more than 50% year over year, the first half of 22 versus 2021. So what that means, of course, is that, for many of the larger aggregators, we've talked about this on a lot of Fortia webinars in the past, M&A has kind of come to a halt. It's paused as they focus their efforts internally. And for other folks, it's meant just to slow down the pace. But I think the really interesting and exciting opportunity here is this kind of what's bolded here in blue font at the bottom, which is that for the folks that kind of planned well ahead, that capitalized their balance sheets well, that are in strong cash positions with kind of healthy debt levels, that they're not sort of necessarily need to be out there raising again now, and they've kind of have built strong reserves and built a sustainable, profitable platform. They're in a position to kind of take advantage of this disruption, right? You can apply more rigor to M&A processes. It's not a land grab. It's not a mad rush. You can be more rigorous around some of your criteria. And as that relates, again, I can't speak to everyone on the panel, but as that relates to branded specifically, if you flip to the last slide here, that's certainly been the case for us. We continue to, if you want to flip, Emmett, we continue to be very active in the M&A market, and we have slowed down the pace. Our goal for this year is to complete fewer but larger transactions. We're looking to double down in our core strategic categories, which again for branded is health and wellness, beauty and personal care, and home and design. We are increasing our focus on profitability and looking to acquire real brands that are consumable, repeatable, that have real customer loyalty, and you can tell real stories around. And we're seeking strong founders, who want to stay onto our platform. And we are just applying a lot more discipline and rigor in our due diligence process, because there's just less tolerance for risk in this kind of market of uncertainty. So we're looking to minimize that exposure. And with that, I will wrap up here.
Great. Thank you very much, Alex. Totally agree with B being bold and underlined. There was an interesting article recently by Buffett who said, in this type of market, the brands who have a proper moat and competitive advantage are true brands with longevity, but also, defensible 20% plus net margins. In an ideal world, obviously it gets harder as businesses get bigger, but brands is critical, and the ability to increase prices in a tough environment is one of the great signals of a very strong brand. There were some questions that came in, Alex, directed at you. Please feel free to give answers that are in addition to what other members of the panelists are adding.
Will do. Thanks, guys.
Thanks, Alex. Okay, I'd love to welcome D1 Brands, Zack Flint. Over to you, Zack.
Yeah, thank you very much. Yes, a quick intro here before we get into it. So For those not familiar, unybrands, New York-based aggregator, really, became an aggregator in the middle of 2020, but began our sort of tenure on Amazon. So we had a core group of team members that have been operating on Amazon for the better part of a decade now, I think just about a decade. And so really, kind of see ourselves as one of the members of the Amazon native cohort, increasingly, the expanding digital marketplace cohort. For those who are enmeshed in this space, like to make a distinction between digital marketplaces and e-commerce because there are some pretty stark differences. So we really tend to play on the digital marketplace side. And in terms of the categories that we kind of look at, we'll get more into this in the future slides, but really more agnostic in terms of category. There's some we like better, there's some we like worse, but really it's really about the focus on brands that are selling in kind of like the mall 2.0, which is a space that we remain very bullish on, despite kind of some of the challenges that I think myself and some of my peers are going to be speaking about today. So if we go to the next slide, it seems like a consistent theme so far in the presentations, but I did want to start with some of the macro implications, and won't linger too long, and especially because there's this slide's a bit of a headache, but in terms of just the anatomy of kind of what we're seeing of the bear market, I think a lot of people are reading headlines and taking it as a foregone conclusion, but not all bear markets are the same, particularly when it comes to the private markets as well as kind of the specifics of the e-commerce market. So the way that we're thinking about it is, obviously the U.S. consumer and the global consumer really more generally is in an increasingly weakened position. You can kind of see the chart there as U.S. household debt on an absolute basis relative to the percentage of savings. The trend all the way up through the first quarter of this year has not been great, particularly coming off the boom times of stimulus, and when people were able to kind of save a lot more money and really weren't spending as much because and this was another boom for e-commerce, a lot of the competing channels were locked down. So we saw consumer products, particularly on in the e-commerce channels, do very well. But obviously all of that cash in the system has led to increased inflation. I think if there's anybody on this call that isn't aware of what's going on there. I think we think of inflation in a couple of different ways. One is obviously the impact on the consumer, but another one which will have some implications for some comments I'll make later is just on the unique supply and demand dynamics within the M&A market itself. It's not a perfect analogy, but one of the things that we've been thinking about recently is sort of what of the selling pressures are for the typical FBA business owner, right? The folks who we partner with. And if you think of their business as almost sort of a fixed income product, I don't think anyone on this call would say that income has been fixed, particularly recently. But if it's a cash flowing business, you could make an argument that the value of those brands, those businesses will trade, more or less like a bond. And so as you have more, inflation and higher inflation expectations, the future value of those cash flows from that business start to look a lot worse. And so I actually think that inflation might be, a pretty large catalyst for increased selling over the next 6 to 12 months. So it's something we're kind of keeping an eye on as we think through the supply and demand imbalances in the M&A market. We've got a chart here on the e-commerce platforms and how they're responding to some of the turmoil. I think everyone will be watching Amazon's earnings next week pretty closely, but there's obviously some divergence between sort of the more established players and some of the more niche players. But these businesses on the left-hand side of the graph, on the bottom left here, haven't posted negative year-over-year comps in quite some time. So we're definitely starting to see this filter through the financials of some of the marketplaces where we all operate. And then where does this all shake out in terms of the valuations? One chart that we are think is pretty illuminating is just we track the fundraising by aggregators over time relative to FBA valuation multiples. It's fairly clear that the significant liquidity in the system for Amazon FBA businesses had a lot to do with the increase in valuations. And so part of that is obvious. There's more cash in the system, therefore there's more dollars chasing a relatively fixed amount of brands. But when we think about how that unwinds, the reverse of that will likely be true, which we expect to drive the multiples for businesses that clear the market lower. But also, everything that we're making a decision on internally is a capital allocation decision. So M&A is one pillar of that for us. But as folks start to think about future fundraising, the amount of cash on the balance sheet, I think Alex alluded to this just before, and I totally agree. The balance sheet position and what you're going to be able to do with your resources. Does M&A look like the most attractive capital allocation decision anymore? We would argue probably not. It's not an unattractive, allocation opportunity. But we'll get into some of why we think, you know, there'll be winners and losers in the next slide. So if you want to just move one slide forward for me. Yeah, thank you. So this is just a quick summary of how we're thinking about, you know, how buyers are going to be able to win in this space. And so we kind of outlined our core criteria here. You know, it comes down to, you know, ASP, which is really kind of on an absolute basis more than a relative basis. ASP on a relative basis being, are you price competitive relative to your competitors? But now on an absolute basis, when we're thinking about the weakening consumer, are you a luxury good, or are you a more of a value good? And we think the value goods are going to end up being winners here for the foreseeable future as people become a little bit more price conscious, and really more of a focus on the supply side. So sellers who really did the work to kind of partner with their suppliers, build redundancy in their supply chains, I think we're going to be in a position to command premium multiples relative to the field, because you know, it has a host of benefits when we think about margin sustainability, because, you know, suppliers are willing to work with you for reduced manufacturing costs, but also on payment terms. As cash becomes king, people that are able to kind of work with their suppliers just to stretch their payables and really have more of a working relationship are going to find themselves as a very attractive asset for potential buyers who would certainly be concerned about those things. And then, you know, kind of talking about, you know, category scrutiny, I think that's always relevant. You know, good to have a bit of humility when it comes to how much you can predict the future when it comes to categories, but I think there will definitely be winners and losers, and I've listed a few of those there. And the final thing I'll say to wrap up is that we think that, you know, a lot of the buying that happened, you know, where people would, you know, buy a business, the team would stay on for 30 days, and then you wouldn't kind of bring that talent in-house. I think those days are largely over. And I think it's going to be much more about partnership rather than transactions. So for you owners of FBA businesses who are looking to sell and are willing to partner with a future buyer, and really kind of sharing the upside as well as the economic risk, I think those are going to be the ones that end up getting more attention from buyers. So I'll stop there, but yeah, no, appreciate the time.
Great, thank you, Zack. And if anyone has questions for Zack, please submit them via the Q&A and address it to him specifically, and he can type those answers as we go through the webinar and or answer them live at the end. Great, thank you, Zack. Okay, I'd like to welcome Jeremy Bell from Elevate Brands up next. Jeremy, over to you.
Hi everyone, pleasure to be here. So next slide, please. So I'm Jeremy Bell. I'm the head of the M&A team from Elevate Brands. And, you know, Elevate is a US-based aggregator. We started on Amazon in 2016 by reselling, you know, Nike and Adidas on the platform, and pivoted the strategy to buying brands in 2019. You know, we've got 32 brands in the portfolio. Year to date, our revenue growth is very healthy, so kind of double-digit revenue growth. And we like to say that's because we're operators first, and we've been on the platform for a very long time. So in terms of, you know, the overarching message that I'd like to impart is, it's our M&A criteria hasn't really changed. What's changed is just risk appetite, and that goes to availability of capital. So to buy businesses, you need capital in the tank, and you know, we're still looking for great businesses. So we defined a great business as something that has staying power on the platform. You've got a clear growth plan, and your performance kind of marries up to that trajectory. So the reason why capital is so important is, you know, public market valuations are kind of down. Everyone's aware of that. When we speak to investors to invest in our business, we're actually coming up against, you know, I can either invest in your business or I can go buy a growth stock that's 70% down. So that's problematic in some ways for every aggregator on this call trying to raise capital. And a lot of people just don't know. They don't know where the bottom is, and because they don't know where the bottom is, you know, investors are just sitting on their cash. So there's, you know, close to $1 trillion sitting in the balance sheet of private equity firms that isn't getting deployed, and there's $3.7 trillion of cash sitting on the balance sheets of, you know, private companies. So if we just go to the next slide, three predictions for me for this year. A lot of people cheered when they saw that the Thrasio kind of SPAC fell over, and there was a lot of kind of mud that got slung around the ecosystem. That's actually the worst thing that could have happened for us as a kind of ecosystem. The best thing that could have happened this year was Thrasio IPO'd, and it went exceptionally well, because if they did, then a lot of investors who are uncertain around the end state here or the end point of the market, you can point to a publicly listed company that's doing very well, and you'd see a ton of capital flowing into the space. So I don't think there's going to be any Amazon aggregator IPOs in 2022. There's one that I'm aware of that may get away at the end of this year. But I think that is a catalyst for a lot of investment to come into this space if they can see that there are listed companies out there doing very well. The next point is, and probably a controversial point, is most of the deal activity this year is going to happen between aggregators. There's a lot of aggregators that bought bad portfolios, and they're going to be in breach of their kind of credit facilities because they use too much debt and they've suffered from kind of margin decline, so they're going to be forced to do it. And then there's a bunch of groups out there which are thinking about it from a friendly perspective, because if you consolidate, you can get to scale, and if you're a scale operator, the thesis there is there's more synergies, it's easier to raise capital in the future, and your potential to go public is slightly easier. So I think you're going to see, if we see a lot of deal volume here this year, it's going to be from there. And then the final point just is the market will recover. If you've got a great business, valuations now are down, just hold on to your business. So if we go to the next slide, I started my career in mergers and acquisitions in 2007. So I kind of rode that huge decline of M&A transaction volumes. And to be honest, in my career in 2009, I didn't really do much. But what happened was when the world came out of 2009, M&A picked up, and there was a record year in 2010. And so the market, when it does return and all this capital that's been sitting on the sidelines does start to get redeployed, you just see a massive uptick in M&A volumes. So the message there, and you can see that in 2020. So there weren't a lot of deals. There was a big step down, but 2021 was a record year. So if you're contemplating an exit and you can be patient, then wait, because when the market comes back, it comes back in a big way, and you typically see valuations re-rate from where they are, at a trough. Awesome. So if we just go to the next slide. So in terms of what to do next, if you're thinking about an exit, there are aggregators out there with capital to deploy. There are aggregators out there who are in trouble, and Emmett and his team know who they are. A lot of aggregators will tell you that they're focused on operations, and that's either because one, they actually are, or it's to kind of mask there's some financial difficulty below the belt. But Elevate, we are in market, we are bidding on businesses, but we are extremely selective. So we're focusing on only the best businesses that we think will navigate the period that, the uncertainty that we're about to roll into. And, if we do think there's risk there, then we'll take that to price. My advice for everyone is just keep building your business. So focus on building your business, focus on launching SKUs, focus on channel expansion, focus on growth. And if you're just focused on growth, you will always get a good outcome in the end, because the market will recover. And the catalyst we think for the market to recover is if we see some stability around interest rates and inflation, then that's when we think a lot of the money that's sitting on the sidelines will start to get deployed. We're spending a lot of time at the moment focused on driving cost out, because what you see in a recession is a reduction in volumes. So go back and try renegotiate rates with everyone from your supplier through to your freight provider through to your Amazon agency, and you'll get the benefit of that when you exit. And then the last one is, if you do decide to exit, have realistic price expectations, because deals can get done, but no one's going to take full price risk in a market where there's not certainty on funding. And the reason for that is, one, aggregators have restrictive debt covenants. So the most amount of debt that they can put into any deal is 3 to 4 turns of EBITDA or SDE. And that means they need to fund the rest of it with equity. In an environment where it's hard to fund deals with, to raise equity, that's why you've seen the drop in kind of valuation multiples to 3 to 4 times, because that's what aggregators can pay under their debt facilities. So yeah, I think that brings to an end of presentation.
Great, thank you, Jeremy. You're making me feel very old with this chart. I started investment banking in May 2000, which is the extreme left of your chart. And unfortunately, it took a lot longer for volumes to come back after the dot-com boom. Hopefully the cycles are shorter as time.
Yeah, the dot-com boom was, you also had September 11 in there as well. So there was a couple kind of events flowed in there, but yeah, I think if you look more recently at 2009 to 2010, the snapback there was really, really strong. So when you start to see when the M&A market returns, it will return in a massive way.
Yeah, fingers crossed that will be held true. Excellent, thank you, Jeremy. Okay, I'd like to welcome Philipp Johnston, the co-CEO of Opontia, to the floor. Over to you, Philipp.
Thanks very much, Emmett, for having me. So yeah, as mentioned, I'm the co-founder, co-CEO of Opontia. So I'm responsible for both the fundraising and also the acquisition side of things. So just a quick intro on Apontia. So we buy brands in Central and Eastern Europe, Middle East and Africa. So we've got a team of about 100, split fairly evenly between Turkey, Poland, Saudi Arabia and the UAE. I think one slightly unique thing about us is we're not buying brands that target consumers in the US or Western Europe. We target brands that sell primarily on local marketplaces and local D2C sites, so not really on Amazon and Shopify. So yeah, to jump into it, I was thinking, you know, because I play these I have these two hats. On one side, the M&A acquisition hat, and on the other side, the fundraising hat. And because most people on the call, I think, are more on the acquisition side, I thought it would be more interesting if I talk kind of from the fundraising, with the fundraising hat on. So I think when I have my M&A hat on, it's certainly, I think, whether it's intentional or not, there's sort of incentives are aligned kind of a bit for the aggregators to maybe slightly play up the severity of the market downturn now, in the same way that when we fundraise, the VCs kind of play up the severity of the downturn, because I think it works in their incentives to drive the valuations down, essentially, that they're paying for companies. So I just wanted to sort of, yeah, as I say, take this from my fundraising hat. And when I wear my fundraising hat, I basically have to try and find the positives in this current market. So I've spent a bit of time thinking about why it's not as bad as it looks, essentially. So this is the graph that everybody is talking about, which is that, you know, public markets are down year to date. I just want to put this into some context. So if you go to the next slide. So here we have, you know, the NASDAQ zoomed out a little bit. So the all-time highs in 2019, I think, were when people were saying this is a too frothy market, this is crazy valuations, etc. We're still 25% above the all-time, you know, the 2019 highs, the pre-pandemic highs. So I think this is probably the most written about and talked about 25% market decline of all time. You know, it certainly doesn't seem to me anywhere near as bad as any of the previous recessions, you know, 2008 or the dot-com bust. Maybe it's something, maybe there's more to come, but if you look at the data, it certainly doesn't look that way. And maybe on the next slide, I've just got a few indications of that. So for example, unemployment rate is continuing to plummet. Corporate profit margins, which are a very key leading indicator of recessions, are staying at all-time highs. The amount of cash that corporates have on hand, which is usually then leads to, you know, if there's low cash on hand, that leads then to layoffs, which leads to a self-perpetuating recession. So that doesn't seem like it's going to happen. And then unfilled job rates is also at all-time highs. So yeah, I think there's been a lot written about this bear market, but I think it's worth just taking a step back and looking at it in context. So how does that play out for aggregators? So I mean, I think there's some optimism for aggregators now. So low multiples have been talked about. I think what we do is a natural hedge against inflation. So typically, as prices rise, you know, we're in the business of selling consumer products, so our prices are going to rise as well. And so long as we're selling relatively good value goods, which most e-commerce brands do, then, you know, consumers are going to end up. Hopefully, the demand should not be as tempered as it would be with traditional retail. So that's on point 2. And also just to add to that, we operate in Turkey. So when we started in Turkey a year ago, the exchange rate was, I think, 8, and now it's 18. So we're very familiar with seeing how inflation can be hedged, and we've done that through, you know, the choice of brands we've been buying rather than through, you know, buying expensive derivatives, for example. So basically, if you buy brands that source locally, sell either to consumers within country or outside, in Turkey in particular, then you can hedge against inflation pretty easily. There's number 3 will be, you know, if it's harder for other aggregators to raise, for those that have raised, and I think some people touched on this, then there's definitely, you know, it's a less competitive environment. And then finally, for us as Apontia in the Middle East, you know, it doesn't hurt that there's been an increase in energy well, essentially in oil prices, and that has led to consumers in the region being less affected, I'd say. And so if there's any, you know, any sellers on the call from our regions, I think you'll probably agree with that. So yeah, that was the main things that I wanted to touch on. It was just to sort of give a slightly contrarian perspective on the current situation.
Thank you, Philipp. And yeah, it's always nice to hear a contrarian view, and the view with the investor hat on is also an interesting take and helps sellers on the call get more context for how you guys think and operate. So thank you, Philipp. Great. Let's move to Germany and welcome Philipp from Stryze. Over to you, Philipp.
Hi, everyone. Glad to be here tonight. I'm Philipp, Senior VP M&A with Stryze Group. Stryze Group is a D2C brand house operating out of Berlin, and we build, develop, and acquire D2C brands, currently mainly focusing on Amazon brands, but still very flexible regarding Amazon D2C brands. In terms of M&A, I must say that we still have a very healthy deal flow. But in line with many other aggregators, we are now very selective. Any potential acquisition target would need to tick a lot of boxes. Which boxes that are, we will discuss in a minute. More broadly speaking, our acquisition criteria regarding products and regions we cover haven't really changed. We still love household and kitchen products, baby products, outdoor and garden, health, personal care, sport products, so fairly agnostic, I would say. And since Europe and Germany is our home turf, that's obviously our main acquisition region, let's say. But we also opportunistically consider US targets. So now let's dig into the acquisition criteria. The first one is certainly financials and KPIs, in particular profitability. Looking at what has happened in the e-commerce space or is even ongoing, should mean no surprise that we currently look very carefully at the financials and other relevant KPIs. We would actually like to see some level of resilience, in particular during H1 2022 over last year. We certainly appreciate the fact that these months were particularly tough. And then margin contraction is certainly commonplace, but we still would like to see margins at least 18% or more, despite the current situation. It's not a set in stone number, but that's technically what we would like to see. In a more normal environment, I think our margin profile would be more in the 25% bracket. Let's see how that plays out in the new normal environment, but that's normally our target margin. In terms of size, I think that is in line with most other aggregators. If we do acquisitions, we would like to look at larger targets, because adding SDE and EBITDA to the group should really move the needle and should be worth the effort and the work. And I think it's fair to bear in mind that many aggregators are currently looking at several projects in parallel. So allocating resources to M&A and the required due diligence should really pay off long term. Stability is certainly another topic. I think last year it was fair to say that we want to see at least 12 to 18 months sales history. Some targets actually had less than 12 months, which was always a bit hard for us to consider. Now I would even say it's a non-starter. Actually, to better understand how a company operates, we would like to see longer sales history and performance. For example, last year we acquired a target that has a history of more than 6 years and a very solid sales record, and not the crazy growth rates we saw last year, but still very solid in the 10% year-on-year range. And I think some stability and planability are quite some assets these days. In particular, looking at the leverage ratios with most aggregators, because eventually you need to make sure that you be in the position to pay back the loans and also cover the interest payments. Then in terms of Amazon, competition is certainly a factor. As I said earlier, we focus on our preferred product segments, which is fairly broad. So hardly anything has changed here, but that might actually narrow down at some down in the future. In line with the past, we want to see great performance regarding the most common standard Amazon KPIs, bestseller ranks, reviews. Generally, strong performance on Amazon compared to competition is key. We like investments in brands that are operating well in the product segments that we know well, because I think that's the best way to unlock synergy potential, because that's the ultimate playbook of any aggregator. What you can also see on Amazon is that advertising costs are increasing. So if the seller actually manages well to get external traffic onto his web shop or Amazon or the Amazon storefront, then this is certainly a competitive edge, which we will look at favorably. Then growth, that's certainly a relevant topic, and that should actually look okay compared to competitors. We would look at the H1 2022 performance over last year, same period. And obviously that was a very challenging period for most brands, but then comparing top line performance to the competition and the overall market, that should actually stack up well here. And if the seller has actually managed to generate some growth in this environment, that would certainly be a great asset. And generally, we will look at how the seller has navigated through that challenging period. Then in terms of future growth potential, I think it would be very beneficial to see a clear set of growth levels that the seller has already identified and well prepared. Ideally, those growth potential or initiatives could be implemented on day one of the integration phase, because you should think it in a way that the more you manage to make life easier for the buyer after the deal, the better. But then, since we're doing due diligence, you should be well prepared for deep dive analysis, and we will certainly challenge your growth assumptions. And one aspect that I will touch upon later again is certainly that we are looking to cooperate with the seller long term, and looking at the growth assumptions that you will pitch during due diligence. I'm pretty sure that we will hold you accountable for them, and your total compensation will, to an extent, depend on your growth assumptions as well. Crossover potential regarding the products on other platforms is certainly something that we will consider compelling. Then another topic is the USP. Last year, we've seen many products with, let's say, questionable USPs. We want to make sure that even in a crisis environment, there's still proper use case for the product, and people will actually continue buying the products, looking at budget constraints. Let's go on to the next slide. Inventory is currently a hot topic among aggregators and general retail. I think many companies in that space are facing overstock issues. So it's fair to say that we will look at the inventory performance of a particular target, and also reflect that in the SPA and APA discussions. Stock outs is certainly another topic. We want to make sure that this is not going to happen again. We normally request 6 to 8 months inventory reach. And then supplier relationships is a key topic, looking at the supply chain constraints in China and the manufacturing plants being shut down. So if there is for example, an opportunity to source the products in Europe, that's certainly an asset. In terms of transaction parameters, it's fair to say that valuation is certainly lower. Last year, we had some situations where SDE adjustments were quite excessive, with some, let's say, funny ideas, looking at add backs for order stock periods, missed revenues, higher supply chain costs, or marketing spend. If you do not have any bulletproof arguments supporting that, you should be prepared that we will delete those. And in terms of structure, I alluded to that earlier already. Be prepared that you will get lower upfront payments, and you should be looking at more deferred purchase price payments linked to financial performance and growth. Last topic before we can wrap it up here. I think the market is turning into a buyer's market with implications on contracts and transaction contracts. I think that MAC clauses will be commonplace, and also tighter reps and warranty regimes with more buyer-friendly caps. I think that's it from my side. Thank you very much.
Thank you very much, Philipp, for that very comprehensive and well-structured answer. Excellent. So in the interest of time, let's keep moving, and I'll invite Brendan Feinberg to the floor from unybrands. Good to see you again, Brendan.
Good to see you, Emmett. Thanks for having me. It's good to be here. Thanks to the 100+ of you who are still here after an hour. I'll see if I can try to add something to this conversation. So just quickly on unybrands, we're a global aggregator. We buy companies across North America, Europe, and Asia. And we heard a lot of folks talking about kind of getting more discerning in their investor criteria recently with the changes in the market. I don't think anything's changed for us. I think like we always have focused on high quality businesses, paying fair values for them, and we'll talk about valuation a little bit after this, and just being a good partner and a good operator. At the end of the day, the deals that we do and the acquisitions that we do, selecting good brands matters, but being super capable operators is what's going to make us successful. And so we've brought in well over 100 people across the world who are world-class operators with a lot of experience, both on Amazon and marketplace channels and building consumer brands more generally. And so I would suggest we still have a lot to learn. We've brought on a bunch of founders in our acquisitions as well who continue to teach us, how to get better. We're really focused on the operating side of the house as much as anything. We do find ourselves in the fortunate position of being extremely well capitalized, and we're very active in the M&A market. We talk to hundreds of companies every month and seriously evaluate bids on dozens of them. And so, that's we find ourselves in a pretty fortunate position there from a capital perspective. And I guess, before we get into a couple of these slides here, Philipp did a pretty good job going into detail around, what are the features of the business that he looks for, and what do I mean when I think about high quality. I would probably distill it down to momentum. So historical momentum, current momentum, and kind of forward opportunity for growth, margins and the sustainability of those margins. Obviously, like cash flows are very important, and defensibility. So what's your competitive position? What's your pricing competitiveness? What other defensibility do you have of product USP? I think everybody's hit on those things kind of in more detail. And that's kind of how I think about, what good businesses look like. And if you have a business like that, I would suggest that it would continue to trade at an attractive valuation. If you want to flip to the next slide, Emmett. So last year, it was a bit too easy. Everything looked good. Everything was like, performing, companies were performing well. There were a lot of active buyers in the space who felt pressure to reach some goals or buy, every business they could get their hands on. I think we tried to be a little bit more thoughtful and discerning at that time. And I think that that's why, we haven't really changed anything about the pace of our acquisitions, our strategy, or the way that we approach this. And this bottom left point, in a competitive market like that, yes, multiples are higher, but we spoke a little bit on this conversation about kind of multiples dropping or multiples changing. I would suggest that less high quality businesses were able to achieve higher multiples than they deserved last year, or in the early sort of like, phase of the aggregator ramp up period. For high quality businesses, there are still motivated buyers, enough of them to make a market, and those businesses will continue to trade at fair and attractive valuations. I think for less high quality businesses, it will become more difficult. So that's kind of how I would start to separate that. I don't really think about average multiples as much as I do, separating cohorts of business quality. And then of course we know sort of, COVID bumps and the approach from aggregators potentially sort of getting more comfortable with businesses and diligence that they might not be today. I think some of those things have changed, and we know that. If you want to flip to the next slide, this is a bit of a micro view where everybody else was taking a macro view. And I think we all know this, right? Like, you look at a business last year, this happens to be a pretty high performing business, one that I would find attractive into this year, continuing to grow. So it's showing that momentum, stability in the margin profile. FBA fees actually coming down, even though Amazon is increasing fees. So that's, either pricing capabilities or retooling, the product mix to more high efficient products. Cost of sales, maybe it's a local supply chain that isn't suffering from high freight charges through the COVID periods. And then we'll look at sort of like contribution margins by category. So this is a high quality business, happens to continue with high quality into 2022 in this example, and will trade at a pretty attractive valuation. If you want to flip to the next page, so where are we now? Obviously, we've touched on this plenty of times in this call, and we don't need to sort of get into it. I would suggest that when we look at average multiples or multiples for average companies or lower quality companies, like yes, those are going to come down, or those companies are going to have a harder time finding a buyer. For high quality businesses, I do not think that those market clearing prices have moved as much as you would see if you looked at like a broad average. And the rest of these points we think we've already hit on. So if you look at that the micro view again, going into 2022, then this happens, right? Margins compress, momentum is slow. So what do we do in this situation? I think if you want to go to the next slide, Emmett, like what should you do as a seller? Because I think that's sort of, there's probably many people on this call who are sort of in that situation, or thinking about selling their company in general, regardless of how their company is performing. Optimizing for the highest price in some future state may not be the best solution. There might be recovery from challenging moments, or the right partner might be the best way to sort of create a liquidity event for your business. Frankly, create some cash in a moment when buying other assets is pretty attractive. And with the right partner and the right deal structure, potentially getting back to what that full value would have been without having to take all the risk on yourself. And so, that's not always the right solution, but if there's a path forward that growth, new products, new expansion opportunities that a seller isn't necessarily like feels best capable to achieve or wants to share that risk, thoughtful buyers can find ways to structure deals around that pretty effectively. So if you go to the next slide, I'm sure what else we've got here. So I think the structure point's super important, when businesses are growing quickly in competitive acquisition environments. You can get a lot of cash at close and create less deal structure. If you need to protect for downside and maybe share some risk, then you just have to be thoughtful about that as a seller. Some of these other points I think are relatively straightforward in terms of what a bigger, better resourced buyer can bring to your company to help kind of achieve some of those momentum shifts that might be able to create full value for your business. And at the end of the day, regardless of the state of your business, like I would test market, share with people, get feedback. We're always happy to see deals and give you our thoughts, and ideally find some transactions together.
Great, thank you, Brendan. Good to see the micro view as well as the macro view from other speakers that are on. Great, so we have one more speaker, and then we will open up to your questions and a discussion. There's approximately 30 minutes left in the webinar. Okay, so let's move to Bruno from Yabba. Over to you, Bruno.
Hey, hi everyone. So yeah, I'm Bruno. I lead the M&A team at Yabba. We are a European aggregator based in Spain, although we have global presence. So yeah, let's move on, please, to the first slide. So what does a bear market mean for sellers? We really tried put ourselves in sellers' shoes to discuss this question, and we've divided it into 3 very simple questions. The first one is what's going on, and what does it mean for sellers looking for an exit is the second one, and then we'll conclude with some concrete advice to stand out and get the best offers at the moment as a sellers. So next slide, please. So yeah, what's going on very quickly on this? I think we've seen some really nice charts today, and we've already discussed that in detail. But you know, COVID, war, inflation, e-commerce not being as resilient as we thought it would be post-COVID brought some difficulties for sellers, which means there are less offers than 1-2 years ago, meaning that multiples have been impacted as well. Which does not mean necessarily that multiples now are cheap multiples, but they are what they are. And in my view, they're here to stay. So basically, what does it mean for sellers, which is the next slide, is also something we've discussed. So I thought I would just include 2 quotes I really like. And the first one is quite financial, and it says, sales are vanity, profit is sanity, but cash is reality. Cash is king. It's always been the case, but it's even more true today that aggregators have a debt to repay, have a loan to repay. So this means that as a seller, if you have a good cash conversion, so if your SD converts really well into cash, if you have a good management of your working capital, that's going to be something that stands out really well. And then if this is not the case, in my view, this should be a short-term priority. And the second quote has nothing to do with the first one. It's a bit more philosophical. It's a bit older as well. It's from Heraclitus, which says, the only constant thing in life is change. So this means that we're facing the challenges that we're facing today, which are inflation, etc., supply chain disruption, etc. But in the end, we need to adapt, pivot if necessary, and we already know some of the challenges for the next years, say climate change, for example, which we should be already addressing, and we'll have surprises as well. Let's say virus, a war, that's something that can come as a big surprise. So we need to pivot, we need to adapt, and that's the key to survival, I would say. And then next slide, please. So I realized that saying that you need to generate cash and adapt is not very concrete. So I really wanted to give some concrete things we like at YABA when we look at sellers, when we look at target companies, and I think these are things that sellers should value. So the first one is when you're looking for a non-binding offer, I think it's very useful if you pitch your pitch with some data and analysis. So I'm always very happy to hear a seller that says that he's optimizing COGS with price reduction, changing suppliers, for example, but I'm even happier if he tells me that this has not impacted product quality, reviews, and market share, etc. So I think here at YABA, at least, we really value when the pitch is prepared, and I think brokers here are very helpful. And the second one is propose your involvement post-acquisition. I think somebody mentioned it before, but I think it's very good value added if someone's proposed itself. Migration, transition, integration risks are risks that buyers can no longer afford, in my opinion. So this is really something that at least at YABA we value a lot, in addition to helping your earnouts as well. And the last one, when considering a letter of intent, is that price is important, so multiple is important, but going to the finish line even more. Make sure that your LOI is going to get you to closing. And in order to do that, I think it's really important to have transparent discussion with the buyer and ask for KPIs. How many LOIs have you converted into due diligence? Have you aborted any due diligence and why? Give me some metrics, ask to speak to some sellers who've already exited. Basically, just all this to say that we are really attached to transparency. at least at YABA. And I think this is the key for the success for the next years, buyers and sellers. I think we're into this together, and transparency will definitely help. And that's the word of the end.
Excellent. Thank you, Bruno. Excellent. So we've had 8 great presentations, some overlap, but we asked each person to present individually, and I think it's helpful to see overlap so there's consistency of message. In the interest of time, so that we've plenty of space for Q&A, I'm going to really go quite quickly through our own slides here. We've given sort of 7 sort of key views as to what we think is happening in the market. So in the interest of time, I'll go very quickly. So trend number 1, some aggregators have paused acquisitions so they can focus on getting their core operations right. What does that mean for sellers on the call? It's important to know who's open for business, who are actively doing deals, or who's focused on operations. Of course, we speak to aggregators every day, so we know who's really open for business. And it's also important to keep in mind, certainly for bigger brands, that you should be talking to PE firms and corporates as well. And we have relationships with those. Okay, second point, volumes of deals are clearly down as buyers are becoming increasingly selective, mentioned by several people on the call today. What does that mean? It was a great quote on our last webinar. Average isn't good enough anymore. Buyers and intermediaries such as Fortia, we're hunting for diamonds. We're spending more time hunting and trying to find the ultimate diamond, the needle in the haystack. And those brands will get bought at good valuations. Number 3, first impressions matter and increasingly important given M&A teams are smaller. So a lot of the aggregators have downsized M&A teams. It's really important to create a good first impression. What does that mean for sellers? In our view, don't come to market until your business is really fully prepared and what we call buyer ready. So to help with that, start planning as far out as possible as you can. Consider hiring advisors, not just corporate finance M&A advisors, but also lawyers and other advisors to help you gear up for your exit. Trend number 4, most buyers would prefer to give up some revenue growth if it meant higher margins. Cash is king in a recession. We've heard that from YABA and others. I often say this phrase, if in the property industry, the 3 most important words are location, location, location. Well, in this market, especially now, the 3 most important words are net margins, net margins, net margins. So focus on net margins and cash flow. The next trend, the above doesn't mean that articulating the growth opportunity isn't key. In fact, it becomes even more important in this environment. Aggregators want to buy brands that have longevity, where there's good moats and prices can be increased. So it is really important to articulate your growth story in your documents when you go to market. And one of the key USPs, unique selling points of Fortia is we have an e-commerce expert, one of our co-founders on the team, led a 9-figure seller and helps clients articulate their growth stories. The next trend is buyers are taking longer to do deals. Frankly, the idea of LOIs in 48 hours or deals closing within 30 days or 35 days was ridiculous last year. We always thought it was never sensible. There's no point rushing deals. Those periods are getting much longer. So it's important for sellers to be more prepared and expect longer processes. In our 7-step process, there's certainly 3 areas where we think we need longer time. One is marketing. We need to make sure that we don't rush buyers, that we find the right buyers and have a sensible amount of time to do so. Negotiation is taking longer to find the right deals, given there's a lot of moving parts and new terms and so forth coming to the fore. And due diligence. I think buyers are spending more time doing due diligence, probably more like traditional M&A. The whole world of aggregator M&A is incredibly compressed, and it's probably becoming a little bit more traditionalized. The next trend is valuations are coming down across the stock market, the e-commerce sector, DTC brands, FBA brands. One can't get away from that. I think it's important to point out on this webinar that a lot of the valuation stats mentioned are specific to FBA brands. They are typically lower than DTC brands, so that's just something to bear in mind. What does it mean for sellers? Sellers have to be realistic about valuation. At the Fortia group, we try to be very realistic with sellers. We're not going to overestimate what can actually get done. We want our clients to have frank and honest advice. regarding valuations. As part of our last webinar, we did a survey of 35 aggregators talking about where our FBA valuations are at. Pre-correction broadly, it was 4 to 6 times, including deferred, and that's come down to approximately 1.5 to 5 times SDE, including deferred. They will go back up as the markets normalize, such as we discussed with Jeremy earlier. Final trend: buyers want to defer more of the consideration. The key thing for sellers here is, look, deferred consideration was always designed by buyers. Earnouts were designed by buyers for buyers. So a lot of earnouts don't get done, or only partially get done. In the bigger M&A world of Wall Street, there's a lot of litigation on earnouts. The devil is in the detail for sellers here, and it's a two-way interview process. Sellers need to increasingly interview buyers. Who's the brand manager? What is their credentials in your category? Have they demonstrated proper operational growth in that category? There are some of the questions that one needs to think about, and also the structure of the actual deferred consideration is important. So be careful. Okay, so we are now, we have 18 minutes or so left for audience discussion. So could I ask, please, all the panelists to rejoin and turn on their mics and their video. We have a large panel today, so I kindly ask everyone to that wants to speak to press the raise hand button on Zoom, so that I'm aware that you want to make a point. Otherwise, if no one's making a point, I'll feel no problem picking on someone. Okay, so in terms of Q&A, let's look in the open questions and kick off. So let's see. Well, maybe I kick off on valuations. So broadly, are people in broad agreement that what we saw pre-correction was approximately 4 to 6 times, and that's now coming back to approximately 1.5 to 5 times? I agree with Brendan, though. Really good businesses will get bought, and there will be outliers. The diamonds can get above 5x still, in my view. Zack, you've raised your hand. Please lead.
Yeah, I would just say that I think a lot of us probably just have the same data on that's hard to find. I was frankly surprised by that, and I think there might be some survivorship bias, because I think if you were paying 4 to 6 times for a lot of brands last year, you may have gotten yourself into some trouble. It may not be kind of a going concern, but obviously there's going to be a lot of difference between whether or not you're an FBA digital marketplace brand, which tend to trade at lower multiples, versus a true D2C with actual kind of relationship with customers, and the growth profile of the brand will have a lot to do with where the market clears at. But yeah, I would say it struck me as high based on our experience, but I'm not sure. I'd be curious of what others think.
I think the range makes, I think 7 is high. I know of one aggregator that did a deal at that pricing, and that's the record multiple that I've seen in this market. And I think that's, to assume a business is going to be around for 7 years is a pretty long assumption for, an Amazon business with low SKU count. It feels like, the types of businesses that we want to buy are closer to 4, and the types of businesses that we want to buy, the seller's just saying to as well, I'm not going to sell for anything below 4 because I'll just wait for the market to recover. I've got a good business. I know it. I'm going to wait.
Great. Thank you, Jeremy. I don't see any other hands up there. So let's move on to another topic. So what about the time to do deals? Are you guys seeing that it's taking you longer to complete deals? Please go ahead, Philipp.
I think that's certainly the case, because we need to look deeper into operations and financials. I think Stryze normally looked at due diligence periods of like 5 to 6 weeks, and now it's probably more like 2 months, 2.5 months.
Thanks, Philipp. Alex? Yeah, I'll echo that. I mean, the whole 30 days, look, we were all in the peak market frenzy. I think we've all, I'll speak for Brandon, we've done deals in 30 days, when we had to. it's not natural. To your point, Emmett, you don't really get deep enough, and it's uncomfortable. So I think one of the silver linings of the bear market is that there's less of a frenzy. There's more. I talked about this a bit in my remarks. You can apply more rigor and more scrutiny, and just kind of really due diligence in the right way to kind of uncover all the risks. And part of that, by the way, part of that process is not just like you learning about the target, it's building that relationship, and doing a lot of that kind of strategy planning and sort of like longer range decision groundwork setting with the seller, who will be your partner. At least the way we structure deals a lot of times is that it's a kind of quasi partnership, not just an outright acquisition, and they go away. So the extra time has been more helpful, and we've definitely seen it expand over the past 6 months.
Thanks, Alex. Bruno?
On our side, timing for due diligence hasn't changed. So we've done some due diligence for simple businesses in 5-6 weeks in the past, a year and a half ago, and we're still doing some of them in this time frame. And for other complex deals, a year ago, maybe we took a few months, and we're still taking a few months. Although what has changed is our analysis pre-LOI. So we're making more efforts to make sure that if we do sign an LOI, we already have a good feeling that this is likely to go to the finish line, basically. So more investigations pre-due diligence, I would say, on our side.
Excellent. Thank you, Bruno. Brendan?
Yeah, it's funny, Bruno mentioned a few things that I was going to touch on here. So I think there's a few drivers to this. One is kind of the complexity of the business, or like how many different sales channels it has, or how much there is to actually learn about. And the other one is how much information sellers are willing to share pre-LOI. So we've, that's been our approach from the beginning that Bruno just mentioned, to have enough information, and we, make certain requests pre-LOI so that we can stand behind the bid that we make at that point, not to sort of get into diligence and then decide what price should be, or if we want to do the deal, but to have some, confidence from all the information that's available to us at that point. And then the more we do deals and better understand categories, have existing assets across categories, the quicker we know exactly what we're looking for, and just spend those first couple of weeks focusing on answering those key questions that we know we're going to have, and then just working through kind of the administrative process at the end around getting a deal done. I don't think that we've seen, a meaningful increase in the amount of time that deals are taking. And as, we get more experienced, I think we get a little bit quicker at it.
Okay, thank you, Brendan. I'll ask Alexei the same question in a moment. The next question after that will be all about timing, a question coming in, which I think is quite good. Should I just wait to sell my business, or should I sell it now? So let's answer that in a second, but back to Alexei for the prior question.
Yeah, and I can probably answer that question as well, because it's a bit related, right? But like in our case, the time to due diligence a brand is still the same, but obviously because there are fewer buyers out there, we are not really in a rush to buy it, so to say, right? And so we actually, as some of the people on the call mentioned, it is a buyer's market. So it means we stick to our valuation, and therefore, if the seller doesn't want to agree on that, we just move on to the next target. And therefore, as a result, it actually does take longer. And we see actually cases where the seller didn't want to sell, and then they come back actually with a much lower multiple, and are actually fine to proceed with the due diligence again. So we see a bit more of that. And then obviously that question you just asked in terms of like, should you sell now? Should you sell later? And I would really say it depends a lot on the personal situation. So if the person has, kind of a stable position and has actually room to grow the brand, I would almost suggest that the founder continues to scale the brand and then just waits till the market recovers, maybe in 1.5, 2 years or something like that, because there are still a lot of the levers which all of us are doing, which are not rocket science. Anybody can really do that, and there are lots of other opportunities to finance a brand. I mean, your sponsor Lequeux is obviously one of them. So I would just suggest, if there is no rush to sell, don't sell now.
And one of the reasons we at the Fortia Group have an exit ready program is to accommodate people that don't want to sell now. I think we're one of the few corporate finance firms that have that type of program. So we're very happy to have partners that want to sell next year or even the year after. Jeremy, I saw you were about to type an answer to that question, so over to you.
Yeah, I think if you're thinking about exit and just timing, like there's a lot of bad stuff in everyone's P&L that people are going to start to walk past. So margins will improve as container prices come down. People will have less inventory at 3PL, so that price will come down. And it's easy to kind of tell that story and get credit for that trend when you can actually see the improvements in your numbers. So that is one benefit of waiting. Who knows what happens to consumer demand, but valuations are depressed. So unless you've got a compelling, as a seller, unless you've got a compelling use for that capital somewhere else that will generate a better return, then think about, holding out for 18 months. I don't think we'll return to the days of 6 to 7 times. I think multiples will be more rational, but the best, that slide illustrated it perfectly, where more capital equals higher valuations, and there will be a lot more capital coming back into this sector, sooner or later.
What about for the sellers on the call? Should they give up some revenue growth in order to focus in on maximizing increasing net margins? Would you prefer that trade-off? Thoughts on that one?
We think about contribution margin dollars. So if you're growing your contribution margin dollars, and maybe you're taking a bath on margin to grow the business, and we can see that there's a story there of the margin improving, then that tends to make us excited.
Zack?
Yeah, I mean, I would agree with Jeremy there. The margin percentage typically is a misnomer. I mean, what you want to do is show more profit dollars, because that's ultimately more cash to the system, which is, I think, as everyone has alluded to, that's become most important. But it really matters to your question, Emmett, about what specific actions you're taking to make the trade-off, right? Like if you're going to go and say, I'm going to spend a bunch more ad dollars inefficiently, then I'm not sure that's the best decision. But to demonstrate pricing power, and although your margins will come down, but you can demonstrate relatively stable sales at a higher ASP, actually sends more signals than just what filters through the P&L to a potential buyer. And we look at that kind of, what has been the trend of ASP at, kind of your core ASIN levels over time, because, if you only look at kind of what's current, you get a really, distorted picture of sort of how the customer sees your value relative to all the other options on Amazon. So I would say there's more to it than just the P&L impact, but largely I think your point's right.
Thank you, Zack. Brendan?
Yeah, so I just want to touch on the should I sell now point, and I guess getting into the headspace where you're thinking about selling your company is obviously a big shift for operators who have been running their business for a long time, and it's a big commitment of time to actually go through that process. That said, having getting a pulse of the market and seeing how people are reacting can be helpful. And if you want to sort of see how we would think about a given situation and build a relationship, like we're certainly happy to look at the business and give a pretty quick feedback on like what we think we would want to see. And I think that kind of leads into the second question, which is should I optimize for margin? I think it's dangerous if you want to run a business for your own cash flows and to take money out of the business as an operator, then yeah, I think you should optimize for margin. If you want to optimize the business for selling it, I think that you should take market share and grow, because I'm much more interested in what we're going to be able to do with the business post acquisition than I am in how much margin it's able to squeeze during a difficult period. So if you see your competitors sort of getting more timid and there's an opportunity to take share and grow, I'd rather see driving growth and believe that whatever happens to the multiples in the ecosystem in the buyer space, I really have no idea what's going to happen. But I do believe that like the consumer issues and systemic cost issues will normalize. I expect that they would. So if you can drive growth through your business and have opportunity to optimize for those things, having taken that share, I think that's a better strategy if you want to sell the company.
Very good. Thank you, Brendan. Okay, so to finish, gents, I'd like to ask each of you to just double down and emphasize the one key takeaway that you want to give to the audience today. based specifically on the topic of today. Who'd like to go first?
I can kick it off, Emmett. Yeah, I think the one key takeaway, even though there's certainly different perspectives on whether we are or aren't in a bear market, the reality is many of the aggregators, everyone on this panel included, are still very much open for business. We're looking to continue to evaluate opportunities that fit with our kind of core strategic criteria. Maybe we're being having a little more scrutiny, but we're still very active. Our core business models are not changed. We are growing through consolidation. And so if you have a quality business that's sort of weathering the storm, and for whatever reason you do want or need to sell sort of now, there's an active market out there, and we look forward to hearing from you.
Thank you, Alex. Alexei.
Cool. Yeah, same here. Open for business. We are very focused on health and wellness globally, and we also look at smaller targets, kind of from $500,000 per year upwards. I think for sellers out there, yeah, obviously there are still a lot of buyers in the game, and the market is going to grow. But in the kind of short term, midterm, the valuations are probably going to be a bit lower.
Very good. Thanks, Alexei. Zack, over to you.
Yeah, I won't make a pitch. I'll say that the last couple of months have been really hard, and I can imagine that for relatively not small, but smaller than an aggregator, brands that have less category exposure. It might be the first real cycle that people have seen, and so I would say that whether or not you're ready to sell, the most important thing is to continue to ask yourself whether or not you're still having fun. You obviously built a business that's you've already made it past that 1 percentile gate if you're in that category. So have some pride in that, but keep in mind that bear markets don't last forever, and really this is an opportunity if you want to continue to operate. Really kind of double down on what your internal processes are, having a stronger business on the other side of it, and make sure you're still kind of learning and having fun and enjoying the ride. That probably doesn't feel good right now, but it's going to end. And if those who can kind of stick with it and continue learning, continue growing, are going to have a great business on the other end, and also learn a ton. So that'd be a couple of words of encouragement.
Thank you, Zack. So 20 seconds from everyone else, please. One punchy key point. Who'd like to go next?
I would like to go next. I think it's fair to say that the market is intact, but everyone is going through a rough period. And I think the sellers who manage to do their homework and come out of the whole situation stronger will actually be in the position to get a healthy valuation in the end.
Yep. Very good, Philipp. Succinct.
I think Zack said it well. This is obviously a difficult time, but keep your head down, control what you can control, run the business as best you can. And if you're interested in selling, let us know. Happy to have a conversation about it. Great.
Thanks, Brendan. Bruno?
No, same here. If you're willing to sell now or wait, I think it's always worth it to have a discussion in no transparency. Ask your questions to us, ask your questions to other bidders, and I think you'll make the right decision.
Thank you, Bruno. Jeremy?
Yeah, I'd say that, markets work in cycles and capital will return to this ecosystem. Aggregators are here for the long term. It is a good business model. So yeah, M&A volumes will return. Just hang in there and keep building the best business you can.
Excellent. Well, thank you all to the speakers. Valuation has been mentioned a couple of times today. It's the topic of our next webinar in August. Was one of the most requested topics, and our goal here is to have some FBA aggregators, DTC aggregators, private equity firms, and corporate venturing folks join a webinar that goes into detail on valuation, and we'll also reference the survey we did last month. So that just leaves me to thank all our panelists and speakers for the great content and the contributions live today. The deck and the recording will be sent to all the registrants today. We typically get a 10x viewership on our YouTube channel. We had 1,000 people already watched last month's webinar, so this content will be broadly watched, and hope you can all make our next webinar in August, and in the interim have some nice time off if you can find it. Thank you, everybody. Have a lovely day. Bye-bye.
Bye.